Hello, everybody. My name is Michael Scott Forehand. Today is February the 1st, 2024. This is our first Debt-Free Life Infinite Bank concept presentation for the month of February. We have one more coming up here a little bit later in the month. And we did one last month in January. And today we're going to be doing our standard Debt-Free Life presentation. We just had a brief conversation a minute ago about some other MEC versus non-MEC conversations. And if you next time we do this, if you want to be in on that part of the conversation, because it's not recorded, show up early. All right, so let me go ahead and get my screen ready and we will get started. There we go. Somebody give me a thumbs up when you can see my screen. Thank you, Mr. Ackerman. Okay, so debt-free life. What is debt-free life? Debt-free life is a play on words. It is a proprietary offering from Symmetry Financial Group. It is it typically uses what we call a participating whole life. And the program is designed to help people rapidly eliminate debts without having to go into debt negotiation, without having to go into debt consolidation, because both of those programs, debt negotiation and debt consolidation, typically fail or they destroy your credit in the process of eliminating your debt. So with a debt-free life program, we're using life insurance, that's the life part, and we're trying to eliminate your debt quickly. And the way we do it is through a process that you're going to see explained to you in just a second. All right. If you're here and you're a consumer, then you've probably had one of these two questions either asked of you or spoken to you. That second question, 9 years or less, actually, when we look at the over time, having done hundreds, if not thousands of these programs over the last 6 years or so, we find that the average return, the average length of time, as far as elimination of time that you're going to be in debt, it actually eliminates that length of time by 15 to 27 years. The fastest program I've ever seen run was 2.3 years. And that was for someone who had a scheduled debt length of 25 years. Okay. So it's there's a function of how much do you fund, which certainly can increase the speed at which the program can work. And there's a function of how much can you have as what we call a debt snowball, which means that's you have a larger debt service. If you've got a lot of debts, for example, then a larger debt snowball is also going to make the program get completed faster. And that other question, I don't think anybody out there short of a really pompous financial planner is going to be 100% certain they're going to have a safe or solid retirement. And I don't know. This is that question. I like the question, but for me, even though I'm pretty good at financial planning, I'm still not 100% certain I'm going to have a solid retirement. For the record, my wife and I, we do have an infinite bank and we do use it. And it has helped us eliminate a significant amount of debt over the last 6 years, to the point now that the only debt we have is a mortgage, a small mortgage that we can pay off whenever we want. So we're in good shape. And we have done that using a debt-free life program. It has done exactly what it was supposed to do. All right. So if you're like most Americans, this is what your current situation looks like. You work hard, you pay a lot of taxes, you pay a lot of interest on your debt service, and you save just a little bit of money. And that little bit, that 3%, the main problem with that, while this 50 years ago, that might have been okay, but the majority of our retirement programs that are out there are no longer funded by our corporations the way they used to be. Now people have become reliant on Social Security. And the problem with Social Security, other than the fact that it's scheduled to be bankrupt at some point, the problem with Social Security is it's not enough. And they've already telegraphed that in 2034, they're going to be reducing Social Security payments by 22%. So if you are reliant or planning on Social Security being the I guess kind of the centerpiece of your retirement program, you probably should rethink it. And I'm glad you're on this call, or at least you're watching this video, because we're going to show you some other ways that you can actually supersize your retirement using this program. And by the way, as long as they're structured correctly, tax exempt. Right on. All right, let's keep going. So most Americans in this country make plenty of money in their lifetime, about $2 million over the course of the average American citizen's life. The problem that most Americans have, though, is that we don't save enough, or that we save inefficiently. So, for example, most people have a thought that a 401k is a great way to save for retirement. Most people have a thought that maybe if you're in the healthcare or education industries, that a 403b, or if you're a federal employee, that FERS is the way to go. In some cases, you don't have a choice. However, the gentleman that invented the modern 401k, his name is Ted Brenna. And he invented the 401k when he was working at Johnson and Johnson. He didn't invent it. He just saw a way that you could use the existing IRS tax code to create this retirement program. And of course, once he did it and started doing it successfully, Johnson and Johnson implemented it, but then Fidelity, which is the #1 custodian of 401ks in the country, Fidelity picked up on it, and that's what they ran with. So, but here's the key thing. Brenna, the guy that started this whole thing, said in a Bloomberg interview in October of 2022, he said, 401ks aren't what they're supposed to be. They're not structured the way they're supposed to be. They're not utilized the way that they're supposed to be. And there's a main problem with them is there's too much taxation. There's too much government regulation. And you really have a big question mark over whether it's all going to be there, because there's all this talk right now. The federal government's spending money like it's going out of style. And there's all this talk out there right now that they're going to start trying to tax 401ks before you actually take the money, or start seizing it if you make a certain amount over too much. There's all that stuff that's out there. I don't think any of it's going to go anywhere, but the problem is that they're talking about it. And once it's in somebody's mind, especially not Republican, not Democrat, doesn't matter. All the politicians do the same thing. They all try to spend too much money and maintain power. So as long as there's an opportunity for them to keep moving forward, they're probably going to. So my consideration is that I don't want my money where the federal government can see it, touch it, or tax it. And that's why the majority of my money is in an infinite bank or in what's called a derivative annuity, which is also protected. So looking at this screen that you see right now, again, $2 million, the average American saves 3%. 3% of 2 million is 60,000. Is $60,000 enough to retire with, including Social Security? And based on the people that I've been working with this week, I'm going to answer hell no. It's not anywhere close. And most people, if you're making, when you're 55, 60, 65 years old, you're getting to the pinnacle of your earning capability. And all of a sudden, you're going to go from earning 150 down to having $60,000 in retirement. How long is it going to last? Less than a year. So not a good place to be. So part of that process is what we do here is we eliminate the debt. We make sure that the debt is gone before you retire, because that's the #1 killer of retirement, is retiring with the debt. And for those of you that are out there saying, yeah, I have a house payment, but it's not really debt. No, it is a debt. And it is going to impede your ability to retire comfortably. And, it's one thing to have enough money coming in to make your mortgage payment. It's another thing to have enough money coming in and not have a mortgage payment and just have the biggest concern to be, which cruise are you going to take next? And that's where I'd like for you to be. All right, so let's keep rolling. So if we look at debt, and you actually talk to quote unquote debt professionals that are out there, those are debt consolidators and debt negotiators. They're going to give you a list of things that you can do to help you manage and eliminate your debt. And everything that you see on your screen right now, all those things, there's only one of them that works with consistency. And that's that debt snowball down at the bottom. Debt consolidation, all that means is you're making smaller manageable debts into a larger unmanageable debt. That doesn't make any sense. Debt negotiation, I'm going to call your creditor and say, hey, you owe $4,000. If we pay you $3,000, can we call it even? That's not going to work. And there's other pieces. If you could save more, you would. If you could spend less, you would. And the last thing in the world we want to do, we were in college at a certain age and we ate tuna fish and ramen. And then we graduated and then we started eating good, healthy stuff in theory. And then we moved on and we started to eat what we wanted when we wanted, because we're making enough money to do that. And now we're talking about going back to eating tuna fish and ramen. Doesn't need to be that way. All right, so let's keep rolling here. Oh, sorry. And that's the better way is what we're going to show you. And that the idea is that we want to move you from the left side of the screen to the right side of the screen. We want to make it so that the money that you're spending and saving is really for you, Not that you're spending money on taxes and not that you're spending money on interest, but we want to make sure that you're able to save. And if we can get you from the left side of the screen to the right side of the screen where you're saving not 3% of your income, but 15% of your income, now you're talking. How long can you retire on $60,000? Not very long. If that number is $300,000, that's a different story. And just as a quick aside, having $300,000 into a retirement program is going to yield obviously 5 times as much as a $60,000 program would be. So if your $60,000 program is going to last you 1 year, then your $300,000 program at the same rate is going to last at least 5 years, but not really, because when you're talking about the part that you didn't touch, it's still going to have some compounding going on. So it's going to last longer. Okay. So that's what we want to do. We want to make it so you're paying less taxes. We want to make it so you're paying less interest. We want to make sure you're saving more money. And then finally, the kicker is this. I know that if we structured these programs so in a manner such that you had to spend more than what you're spending right now, that you wouldn't stick with it. And that you'd get into it, you'd pay it for maybe 6 months, maybe a year, and then you'd quit. And then you'd say, oh, Forehand lied. It really didn't do anything. Well, no, you just didn't execute the program. So what we try to do is you try to find places where you're spending or saving money inefficiently. Those would be like, I want to pay my mortgage down fast, so I'm spending an extra $500 a month. Okay, what's really happening when you do that? I'm taking $500 out of my checking account and giving it to my mortgage company for $500 of increased equity. I didn't do anything. All I did was change the status of that $500. When it's in my checking account, it's mine. I can do whatever I want to do with it. It's liquid. And when I convert it into equity in my home, it's locked up, it's sequestered, and I can't get to it unless I want to take a loan or sell my house. So the idea is that we want to maintain liquidity. We want to give ourselves an opportunity to have and maintain choices. And we don't want to be stuck using the old methodologies that we are all taught, which were taught by the banks, of how to get into debt. They make it real easy, and how to get out of debt and make it real hard. And they want you to get out of debt the way they're going to teach you, because when you do it their way, which is pay an extra $500 on your mortgage so that you can have additional equity sooner, when you do it their way, you're actually doing it the way they want you to, because they're still making money on you. You're not making any headway. All right, let's keep rolling. So if we can do all these things that you see on the screen, all these bullets, that's what our system is designed to do. And that's what we should all be trying to do. We want to get out of debt. We want to retire sooner. We want to reduce the amount of taxes we pay over time. We want to reduce the amount of interest we pay over time. And we want to be able to save more money for retirement so that we can have a nice, comfortable retirement. Okay. There's a lot of programs out there that talk about different ways that they can teach you how to do this. Okay, there's a program out there called the Australian model, where you don't actually have a mortgage anymore. All you have is a home equity line of credit based on your home, and you go up and down within that home equity line of credit. That is also, and they're calling it an infinite bank. It is not. It is a great way to give access to equity in your property to something that shouldn't have access to equity in your property. So that methodology is not a good method, in my opinion, especially. And I've got clients right now that took out that line of credit 3 years ago when it was only 2%, and it just adjusted, and it's up to 8%. Now they're screaming, how do I pay this thing off? Well, and I don't want to be the I told you so guy, told you don't do it. I don't want to be that guy. So now we're looking at, okay, so we can take some money from here, take some money from there, and that's it. You don't want to put yourself in that position. So the home equity line of credit version of an infinite bank, or the Australian model version of the infinite bank, is not a good thing, not a good place to go, especially considering home equity line of credit liens, mortgages, loans are variable rate loans. I can't tell you, nor can they, what your interest rate is going to be 5 years from now. Nobody knows. But the problem is, if it goes up 5%, then you're not going to be able to afford it. If you're cutting the line real close about what you can afford versus what you actually purchased. Okay. So With those other models, the main thing that a lot of those models forget to take into consideration is an emergency fund. So if it's a home equity line of credit model, or the Australian model, there's no emergency fund. The emergency fund is over your head. And if you do too much, then you're out of your house. And then you get to go get an apartment and live with lots and lots of people. That's a lot of fun, right? Not when you're 50 years old. There's another version out there called a sweeps model or sweeps campaign, SWEEPS sweeps. It's just like using a broom. And all that model does is it moves money from one account to another account every night, moves it at 11:59 p.m. into the other account, and then moves it back at 12:01 a.m. into the current account. So you're taking advantage of having funds in a higher interest account than you have your money sitting in currently, and you're able to still have access to the funds and be liquid when you need the money. That's all. Those programs do work, but they're only really reserved for really wealthy people. By wealthy, I mean the capacity to move $100,000 a night really is where that needs to be. All right, and finally, there's 3 different life insurance programs that can be used to create an infinite bank. One of them, indexed universal life, probably a bad idea for the same reason that the line of credit methodology is a bad idea, because it's variable. You'll have years where you don't have any gain. You won't have loss, but you'll have years where you don't have any gain. And if you're trying to do a debt elimination strategy without knowing where you're going to be, then how can you do a debt elimination strategy if you don't know how much money you're going to have or when? So that model's out. The other model is the one that John Rockefeller used back in 1904, which is just a standard whole life. And that model does work, albeit slowly, because it doesn't have the growth rate that a participating whole life has. And that leaves one, which is the participating whole life, which is what we use. So in our participating whole life program and in the Rockefeller program, the standard whole life, there is an emergency fund. There's an amount of money you can borrow. Then there's an extra amount of money you can take if you really, really need to. And the extra amount of money, if you take it, the reason why you're taking it is because you're surrendering the policy, cashing it in. That's why. So there's an emergency fund, but you only want to do it in a real emergency, not the I want to take a trip to Tahiti emergency. Okay. So if you compare these different types of programs, tax exempt, tax deferred, and taxed, there is no comparison. Anytime, hands down, a tax exempt program is going to outshine a taxed program or a tax deferred program. If you use the same method, the same metrics, 28%, 28 years, $10,000 invested, 7% average interest rate, good luck finding that, and in a taxed program, and then a 25% tax rate. That 25% tax rate is and in modern times, this is a 4-year or 5-year-old slide. In modern times, 25% means you're making somewhere between $190,000 and $230,000 as a married couple filing jointly, or I think it's 158 if you're filing single. So that's your tax bracket. So using the same across the board, the same average returns, the same average amount of money you put in, the same length of time, the same growth rate, the same tax rate, there's no way a tax deferred or a tax program can meet up with the value of a tax exempt program. Probably. If you had a market gain of 20% 5 years in a row, then yeah, you do better off than that. But that's never happened. So there's a possibility, but it's probably never going to happen. All right. This is a financial instrument. Like all financial instruments, it works in phases. There's a phase of time where you're building up to the point where you can get as much money going into the program as possible. There's that phase of time where you've reached that pinnacle of involvement, that pinnacle of how much money you're putting in every month. That's the accumulation phase. And then there's that phase of time where you're no longer contributing to it and you're actually just distributing money from the program. That's obviously the distribution phase. And our goal with these programs is to get you out of debt as quickly as possible, because by eliminating that debt, that puts us into that position where we are having the maximum amount of money going in every month. That gets us to that accumulation phase as quickly as possible. And then ultimately, the distribution phase. There's different ways to access money in the distribution phase. One way is just simply to be taking the money out of the program. That's fine. Another way, which is an advanced version of these programs, is to do a derivative annuity, which is nothing more than an annuity, which is an income stream that is derived from something else. So a derivative annuity is an income stream in the form of an annuity where the funding for the annuity kind of came from this program. And that's something that you need to have a conversation with your financial professional if you want to structure some of that stuff and make sure that it's structured correctly and make sure that you are able to answer the questions that you have to answer to be able to put those programs in place accurately and legally. All right, let's keep going. Like I said, this is we found Rockefeller did the first one of these back in 1904. These are some of the other famous people that have done these, and the list is really endless. There's tons and tons of people. This was for a long time a wealthy person's tax shelter, and it is now a everyday person's retirement program slash tax shelter slash debt elimination tool slash legacy tool slash wealth creation tool slash wealth transfer tool. It does all of it, checks all those boxes, which is really strong. So Disney did this to fund both Disneyland and Disney World. Doris Christopher did this to start Pampered Chef. Ray Kroc did this to build the first 11 McDonald's units after he bought the first one. And then finally, Warren Buffett still does it to this day. But last time I heard, he had about 14 of these programs running for him and his family. If he thinks it works and I believe him, then I think it works. All right. Actually, in reality, folks, I've done these. I've done these on my family. I know they work. All right. So we're going to do this by harnessing the power of life insurance. And by harnessing the power of life insurance, we're going to be able to accomplish, excuse me, we're going to be able to accomplish all those things that you see on your screen. Not hard. It's not rocket science. It's a pretty simple, straightforward program. But make sure that you're using your financial professional, especially for the couple of rounds, when you're actually going through that process of funding it and then taking a loan and paying off a debt, and then increasing the funding and then paying a loan and taking off a debt. All right. All right. So in the end, this is some of the results that we've seen over time. These are actually pretty small at this point. My number one client has eliminated in 4 years about $1.9 million and created about $3.5 million of wealth. And that's just over 4 years using this program. All right. So how does it work? Well, before you know how it works, you have to understand how you spend money. Okay. You spend money and save money the way the banks have taught you, because every time you put money into your bank account, your bank is earning 61 cents and they're not giving you any of that money. So it's in their best interest, in the bank's best interest, for you to keep your money in the bank and let them use it. And let's say you say, oh yeah, but Scott, I'm earning 5% in my high yield savings account. Yes, you are. Do you think they're paying you 5% because they're only making 5% with your money? No, they're making an average of 61% with every dollar you put in. So here's how you spend money. You make money, gets deposited as income into your checking account. When it makes it to your bank account, the bank takes that money and uses it over and over and over again. They lend it out every night at the federal funds rate or higher. The average dollar that you put into your account is lent out at least 7 times before you actually get to use it. And then finally you say, hey, bank, I need to pay my car payment. Please go ahead and move some of that money and pay my car company. And then when you do that, what happens? The bank sends the check, or the bank does a wire transfer, or an ACH, sends the money to your creditor. And then that money, which was your money to begin with, became their money. And I don't care how sweet you are, how nice you are, how smooth of a talker you are. There's nothing you can say that's going to make that creditor give you back your money. Your money is gone forever. It is not your money anymore. It's their money. And in that example, you have traded X of your cash for X of your debt. And it's a wash, and you have zero gain. And the only entity that made any money in that entire transaction was your bank. and they don't even thank you for it. As a matter of fact, I think the thing they'll do is say, hey, thank you for keeping at least $2,500 in your account with us. Because you did that, we're not going to charge you a fee to keep your money with us. And we're not going to pay you any of the profit that we made with your money. That's really what they're saying. So now that you understand how you spend money and who's making money the way you spend it, let's change the game. Let's show you how to spend money using a debt-free life method. So you same job, same money, same bank account, but here's where the game changes. You're making a premium payment for life insurance. It specifically is whole life, and that in our case, it's participating whole life. And that premium payment that you're making is split once it gets to your life insurance company. It's split three ways. Okay, it's split into the primary policy, which is a whole life policy, into a term rider, and into a paid up additions rider. And if you were on this call earlier, you heard Drew talking about PUA. That's what PUA is, paid up additions. It's additional life insurance. What it stands for is paid up additional life insurance. That's it. So when you do this, every time you make a premium payment, some of it goes to pay for your whole life, some of it goes to pay for that term rider, and most of it goes to pay for your paid up additions. Now, here's the cool thing. The way the IRS sees these payments that you're making, you're buying life insurance. Some of it's whole life, some of it's term, and some of it's paid up additional life insurance, right? So everything you're paying is for life insurance, okay? Now the carrier sees it differently. The carrier says, well, it's whole life, and whole life traditionally has a cash value, so we're going to be growing cash value within the whole life core policy. The term, that doesn't give you anything other than increased death benefit. The paid up additions, well, that's also permanent life insurance like whole life, and it's got a cash value to it. And here's the thing. If I buy $1,000 of paid up life insurance, how much is it worth tomorrow? $1,000 of paid, whatever the value of that life insurance policy was. It's the same. The value stays the same. And if my carrier follows that track, which they do, then that $1,000 of permanent life insurance that I just bought, it's going to be worth $1,000 next week, next month, next year, a decade from now, 20 years from now, depending on if I'm still alive or not. So the whole idea here with this entire process is I'm putting the money in a situation where it's a permanent asset. And we're not the only ones that are saying this, folks. Banks say this. Banks love this. There's a thing called bank-owned life insurance. There's companies out there called viatical settlement companies. And all they do is they go around and they try to get people that have life insurance policies that have a cash value to sell it to them at a lower rate. Or life insurance programs where, let's say you have somebody who's got stage 4 cancer and they're going to pass in 5 months and they need the money now. If their particular life insurance policy didn't have a clause where they could advance the death benefit, then you might be able to go to one of those viatical settlement companies and say, look, I'm going to die in 5 months. I've got a $100,000 policy. Can you give me something for it? And they say, sure, we'll give you $60,000 for it. And then you pass, and then they get the benefit. Okay. So banks understand life insurance. They understand that there's inherent value in it, especially in programs that are paid up, right? Paid up additions, paid up or permanent, whole life. Okay. So if you think about it and you look at the numbers that are out there, PNC Bank is one of the largest holders of bank-owned life insurance. They have over 19 billion in life insurance policies that they own. There is a company, UBS, actually just tried to sell their $200 billion book of business of life insurance. I don't know why, but that's just something that came up. It's an asset. So if the banks see it as an asset, and they actually see it as a very safe asset, why? Because what I've been talking about, zero chance of loss, zero cost to maintain, and I know exactly how much it's going to be worth 5 years, 10 years, or 15 years from now, is a permanent asset class. Is it better than gold? Maybe. How much is gold going to be worth 2 days from now or 10 years from now? Is it going to go up? Maybe. Has gold ever gone down? Yep. So if you think that the gold standard, quote unquote, of retirement investment is gold, I would say nope. The gold standard is probably life insurance because everybody has it. And it's not just the banks. Ford, GM, Heinz, these are other major corporations that all have bank-owned life insurance, or in this case, company-owned life insurance on their books as an asset to help them make, when it comes time to determine the valuation of their company, it boosts up the valuation of the company. And if I can buy something that's worth $100,000 for $10,000, then the minute I do that, I've increased my net wealth by $90,000, and that's why they do it. All right, let's keep rolling. So the money, once it makes into your bank account, then the circle that was revolving before over your bank, your Wells Fargo Bank of America bank, it's now revolving over your debt-free life or infinite bank. That means it's earning, it's churning and burning. It's earning an average of 3, 4, 5% guaranteed interest, plus a dividend of a half, 1.5, 2.5, 3.5, up to 5% dividend every year. Okay. And then finally, that day comes when you have to make that payment. So how do you do it? Do you write a check out of your bank? Yes. But before you write the check out of your Wells Fargo bank or Bank of America bank, you're actually going to pull the money as a loan from the carrier. So your money is still in here. It's still churning and burning, earning a guaranteed interest rate and a dividend. And you're using that as collateral to take the loan from the bank. The loan gets deposited back into your checking account, and then you go back into your regular bank's bill pay system and tell your bank to pay the debt, and then the debt gets paid. In this example, where's your money? In the previous example, your money became their money. It's gone forever. Your money is now their money. In this example, the carrier's money is now their money. Your money is still in your infinite bank, which is one of the reasons why this is called an infinite bank, because you're using the same dollars over and over and over again. Okay. So if I want to look at how these things work, let's go here. You guys see my debt-free life bank thing here? Give me a thumbs up, Mark, if you see it. There you go. Thank you. All right. So this is a family, and I just met with them. October was their 5-year anniversary, 4-year anniversary. Yeah, 4-year anniversary. And they are on track. Actually, they've accelerated there because they've been putting more money in here than we originally scheduled. And they're out of debt almost. Okay. So where they were before we met them, they had student loans, back taxes, some medical bills, credit cards, car loans, 2 properties. They had a lot of debt. Okay. But not really. Their total debt load was only $585,000. 2 houses, right? And student loans. That's really not a lot to have 2 houses and student loans. Not a lot. But because of the way that their debts were structured and the amortization schedules associated with their houses and the evil thing called a student loan that's in deferment, their debt is 40 years long. So on their current track, he was 36 when we started this. At age 76, they will be debt-free in their current track. And they will have 100% equity in 2 properties, one of which is probably going to be a cash flow rental. That's their retirement based on their previous situation. With our situation, got them out of debt. Can you guys see that? There's something on my screen that's getting in the way. Got them out of debt in 7 years, 7.8 years. This isn't magic. It's just math. And it's also taking advantage of and using amortization schedules against the companies that like to use them, like banks, mortgage companies, credit card companies. Okay. So all we're doing is we're turning the tables on them. I'm giving them more money than they're expecting me to give them before they're expecting me to give it to them. And because of the arrangement, they have to take it. They have to credit it, and that destroys the downline interest. So that's why when you look at this next screen, that's why this says what it says. I'll give you guys a second to look. We eliminated their debt in 7.8 years. Okay. By eliminating it in 7.8 years, we saved $70,000 of interest. Okay. And remember what I said a minute ago. In 40 years, when they would be debt free normally, they'd have equity in two houses, one of which would be a cash flow property, and that's their retirement. In this example, they have the same two houses, equity in two houses, same cash flow property, but they also have $4.8 million of additional cash. And then there's also a fully paid up life insurance policy worth over $1 million. Couple of things. So this is the actual schedule for these people. They've accelerated and they're going to be out of debt at the end of this year. So they're going to be out of debt at the end of 5 years because they've been throwing extra cash at this thing. And what you see here is that when we structured the program originally, we asked the gentleman, how old do you want to be when you retire? And he said, well, I'm going to have to work till I'm 75. As long as I can work, I'll work till I'm 75. Sorry, folks. So I'll work till I'm 75, but I'll be debt free. And I'll have my house paid off, my car's paid off, and I'll have a rental property and have income coming from that. So I'm good to go. Okay, you are good to go. What if we can make it better? So that was that conversation. And this is where I showed him how this program works. One of the key things I want you guys to take a look at is he wanted to work till age 75. Why? He never said because he wants to. He said because he has to. Okay? He wants to work to age 75 because he has to. In this example, we actually got him out of debt early, a lot earlier, and had him building that retirement nest egg early. Okay. It's not just that we eliminated 70-some thousand dollars of interest. It's that we actually made it so that since those debts weren't there and the debt load wasn't there, we were able to hammer his retirement without doing anything else, just using this program. At age 55, he'll have $1.512 million in the program. And you see, if you're on TikTok or Twitter or just doing late night surfing, Instagram, whatever, or looking at all that stuff on Google surfing, whatever. If you're looking and you keep seeing this thing come up, I've got $500,000 when I retire. Is that enough for me to retire on? And so there's a lot of people questioning whether or not $500,000 is enough to retire on. Well, in this case, this guy's got at age 55, 1.5 million. Okay. So the point is that this program grows cash and it grows cash fast. And then there's a compounding effect. If he wanted to, at age 55, he could actually stop the program, do that process called reduced paid up, which makes it so they give a guaranteed permanent death benefit that grows over time. They have the cash that's in there. It's yours immediately if you want it or whatever portion you want. And then you never have to make premium payments again. If he did an RPU, in this case, at age 55, he'd have a death benefit of around 1.1 million, and he'd have a cash value of 1.5 million, and he would have an ever increasing value of about 120, somewhere between 110 and 120,000 dollars a year income every year for the rest of his life. And oh, by the way, that's tax-free income, folks. So that's not $110,000. That's about 180 after you pay taxes. So if you were going to be using a taxed program to get that 110. So this is why these programs are so powerful. It's because we can leverage the money in a life insurance vehicle. We can take the protections offered to us by the IRS under IRS tax code 7702A. We can also take the protections offered to us if we're a business under tax code 162. And then we are able to access the funds. So in comparison to a retirement program is going to limit the age at which you have, or a minimal, there's going to be a minimum age that you have to be before you can access the funds. There's also going to be an age where you don't have a choice, but you have to start taking the funds. That required mandatory distribution. This program doesn't have either. It's life insurance. There's no retirement restrictions on it. You can take the money when you want. You take it as a loan. You can actually cash the thing in and get a ton of money. There's all kinds of stuff to do with it, but there's no restriction on when you can get access to it. And that's the beautiful thing about this. I hear other people say, yeah, Scott, but what about an IUL? It performs better. Well, yeah, maybe. Depends on how long it's performing for. Is it performing for only 5 years? Then let's play. Because I bet you're going to have a couple of years in that 5 years, we're going to have flat numbers. And I would bet that after you get past that point, that you're no longer having growth. Well, our program has growth until you pass. There's a key difference there. Also, when you compare this to other versions using index universal life's IULs, for example, there's a limitation of when you can gain access to the money. It's usually about a 1 or 2 year window. And there's also a significantly higher loan cost in an IUL, where here we have the ability to generate what's called arbitrage, meaning that I'm earning more interest on the money that I'm borrowing. And that's a very, very difficult thing to do when the interest rates for loans are as high as they are in IUL systems. Okay. So I think that's about it. Yep. So let me go ahead and stop my share. All right. I see at least 4 people still awake. That's awesome. Thank you for staying with me. Keep me company. I have a little bit of time left. If anybody has any questions, we can go through that. And I'm going to blow my nose one more time. I apologize. I apparently came home from Florida with something. Okay. Oh, Devin, I saw you wrote some business the other day. Actually, yesterday. Congratulations, man. I'm super proud of you.
Thank you. Thank you. I actually do have a question.
All right, go ahead. Hit me.
Someone that is, older, let's say they're already 55, 60, does this plan still work as
Absolutely. Yeah. These programs work for people up to age 75. I don't like to do them for people over the age of 69. Because if you're going with an age 71, 2, 3, 4, 5 client, there's only one company you can put them with. And that one company has a very high minimum whole life policy, which means you're taking out a large whole life on, which is an expensive proposition, but it's on an older person, which makes it even more expensive. And those programs are going to be onerous as far as the cost is concerned. So 69 is about where I stop. And then once we go beyond, I've done these programs for people that are in their 80s, but they're not the target of the insurance. They become the owner, the payor, and the beneficiary of the policy, and the user of the policy, but they're not the insured. In that case, I did one for a medical school dean, and we put it on his son, who was 55, and he was 84 when we did it.
It worked for me because I was just at that 69 limit.
Yep. You
But
got
it
it
worked
under
for
the
me
wire.
because it helped me diversify my savings.
Yep.
So it was worth it converting investment money into insurance policies that I
Which
can,
is, in this case, in your case, it's still an investment. It's an investment.
yes, still an investment.
Yep. So, and for the record, folks, Andy's one of my clients, or Drew's one of my clients. I didn't pay him for that. He did that all on his own. Okay. Thank you for
That's about the same thing you did for me, right?
There you go. Aura is another one of my clients. Thank you, Aura. Okay. All right.
Scott,
Anybody?
are there any like medical conditions that will disqualify them from something?
Absolutely. It's life insurance.
Right. So is diabetes a no-go, or is cancer? Like what's the line?
If it's diabetes with complications, neuropathy, nephropathy, retinopathy, it's a no-go.
Okay.
If it's congestive heart failure, no-go. COPD, no-go. Cancer within the last 2 years, no-go. So I mean, it's standard. It's the same thing. If you've got a whole life policy, actually, no, these are going to follow term. So if you've got a term policy, if the client can qualify for term, they can qualify for this. If they
Okay.
can't qualify for term, they're not going to be able to qualify for this.
Thank you.
Anybody else? All right. So what's going to happen next is Dr. Burr is going to be administering the quiz. Okay, so get out your pencils, and I think this is a Scantron, so make sure you have your number 2 pencils ready. Okay, so Dr. Burr is not only going to be administering the quiz, he's going to be grading them. Okay, so Dr. Burr, what's the first question of the quiz?
Actually, I had a client just a couple of days ago that came to me that presented kind of an interesting wrinkle on this whole thing that I think is worth discussing. She is a 63-year-old woman who has $114,000 in an IRA. I'm not an IRA, a 401k with an employer that she's still employed with.
Okay, move it all.
She told me she came to me supposedly as an IUL lead, and she started the conversation by saying, you know, I don't want to waste your time. I wanted to let you know I already have an application in process for an IUL. And she said, and I said, you know, what's that about? And she said, the agent who my sister referred me to told me that I should take $25,000 out of my IRA, out of my 401k, and put it into the IUL as a lump sum initial payment into the IUL. And, you know, I've been trying everything I can to get her to understand that that's not a wise thing to do. That, you know, she said, well, I'm going to owe taxes on that money anyway when I take it out. And I said, yeah, you are going to owe money. You are going to owe taxes eventually on that money. But does it make sense to owe taxes on it now and take all that money that you just lost in taxes out of the possibility of it continuing to accumulate in whatever form you're thinking of doing? And what I suggested she do is to continue with the 401k as it is, except take any additional funds above and beyond her match and put that into an infinite banking program. And then whatever she's able to afford going forward, to put that into a participating whole life program. And then when she retires, she can put that 401k in an annuity. And in the meantime, since we are in symmetry and quality, she can have QFA manage her 401k actively and potentially do better than whoever's managing it now.
So did you bring that up because you want my recommendation?
Yeah.
Okay. She should do an in-service distribution of her 401k immediately, and she should move it into either the Prime Path Pro if she doesn't have long-term care coverage over at North American, or move it into the Security Benefit 7, which is offering a 17.7% annual gain. Both of those will outperform the IUL.
Okay, and she's
she's
allowed to do that even though she's still employed with the
Yep.
with the
Yeah, because
401k.
the ERISA Act, ISA, allows employees after age 59 and a half to do in-service distributions from their current IRAs, so they can move it to a place and save it.
Okay.
So right now in her IRA, it's at risk, so she can move it to a place where it's not at risk. Now, she can't realize the funds. If she realizes the funds, there's a taxable event.
Right.
Okay, but she can have it moved or rolled or transferred into another type of IRA and an annuity.
Oh, that's great. I didn't realize that she could do that after
Yep.
age 59.
59 and a half. That was a fun one, Peter. Dr. Bird. Thank you,
No
sir.
problem.
Anybody else? There you go.
Rebecca Fontenot, if you could just repeat the two places that you mentioned to Peter. You said Prime Pass Pro.
So the North American is the name of the company.
Mhm.
The Prime Path Pro is the name of the annuity. That's one option, depending on whether or not she's got long-term care coverage. If she's got a long-term care policy, then you don't do that when you do the other one. The trade-off is the Prime Path Pro offers a lower return, but it offers a long-term care doubling analog. So if she gets to that 2 activities of daily living, can't feed yourself, can't bathe yourself, can't dress yourself, can't take your medication, can't drive yourself, can't get in and out of a chair. If you get 2 activities of daily living, which is the standard way you qualify for a long-term care benefit, then that triggers a doubling of the account value. So if she, like in Peter's case, let's say she moves 104 and it happens 6 years from now, that particular program using an index called the Morgan Stanley Dynamic Global Index, MSDG, that has about a 13% per year average gain. That one, she would be able to say 13%, in about 5 years, it'd be close to doubling, because it's compounding the compound. So in about 5 years, it would have doubled. So it'd be $200,000. And if she had a triggering event at that time, it would take that $200,000, turn it into $400,000 that she could use for medical purposes, assisted living, skilled nursing care, in-home nursing assistance, whatever, all that kind of stuff that you need when you reach that point in your life. So that's one. The other one is the security benefits. Using the UBS MAIA, that's the Multi-Asset Inflation Aware Index, MAIA index. And the MAIA index, the free version of the MAIA index, has an average gain of 17.7% year over year. And the for fee version has an average gain of 26%. So that's one of the 2 places where I'd put it. And actually, if again, thinking about this, there's a process that we do that I teach called annuity stacking. And the concept behind annuity stacking is I want to distribute the risk of timing. Did the money, here you go, January. Let's say you move $100,000 into an annuity in January, and then the market drops. It drops 15%, and it comes back over the course of the next year, 15% back. That means that the market is the same value when you started as when it ended. And the way annuities work, the gain in an annuity is based on the index move over time. And that's it. So the index move, if it's worth X here and it's worth X here, the move is 0 and you gain nothing. But if you distributed that risk, the timing risk of, okay, instead of moving $100,000 in January, let's say I'll put 50,000 in January and 50,000 in February. If you do that, then the 50,000 in January is going to have the same problem. It went down and it came back. It still was, you didn't have any gain. But the 50,000 in February, because you started it at the bottom, it's going to have all 15% gain. In that example, the gain is 15%. So my total, the 15% on 50,000, then you look at the multiple. So if I did the free version, the 0 cost version, the multiple is 1.4. If I did the for fee version, the multiple is 3.3. Okay, so I paid 1 point to have 3.3 times 15% go up. So in that example, by using that distribution model and separating that 50,000 into, or that 100,000 into 2 $50,000 chunks or stack components, one in January, one in February, what I just did was I pretty much guaranteed a gain in a place where I wouldn't have had a gain if I'd put it all in January. So that's why it's, again, Andy said this earlier, this is about distribution of risk as much as anything else, having different incomes, places. So the same thing is true with annuities, or in this case, a derivative annuity. If you're bringing the money out of the program to start one of these things, which you can't do, there's a speed limit. And if you don't understand that, don't say we're going to take money from your life insurance policy and start an annuity, because if you're borrowing money, you cannot start a life insurance policy or an annuity with borrowed money. That's a no-no. Okay. I've never told you to do that. Ever, ever, ever. Okay. So in that example, going back to that $100,000 example, putting all $100,000 in January gives me 0 for the client. Separating it into 15 to January and 15 to February, going to give me that 15% gain plus the multiple to 1.4 or 3.3. Using the 1.4 multiple, that 15% gain became about $10,000. So I went here, I had 0 gain all in one, or I split it into 2, and combined the 2, I had actually a 10% gain. 10% is a heck of a lot better than 0. So that's why you want to distribute risk, timing risk as well, when you're doing annuities or derivative annuities.
Who was that second annuity company you mentioned? Security
Security benefit.
Benefit.
Yeah.
Scott?
Yeah, that's through Advisors Excel. And then if you're looking for pure income stream and you're not looking for growth or accumulation, pure income stream, the Investor's Heritage has probably the first or the second best income stream on the planet right now. And actually Nationwide has either the other one, the first or the second one. They both have excellent income stream programs. Yes, Dr. Burr, you don't have to raise your hand, sir.
Yeah.
You're a guest of honor.
Excuse me. Once the in-service distribution was done of the annuity,
Mhm.
what would you recommend the woman do with any additional funds
Sure.
that she was going to try and put toward
Right.
retirement?
So the discovery phase is going to discover where she's spending and saving money inefficiently. And if she is spending or saving money, if she's putting money into her 401k and receiving a match, that's fine. I'll always take the free money. But if she's putting 10% in and she's only getting 5% match, then she's overfunding the 401k by 5%. And that's where I would look at where we're finding the money. Okay. And then I would repurpose that money into an infinite bank. She's of age where she could do it. And then it comes back to goals. What is she trying to do? Is she trying to leave a legacy for the family? So one of the things we just did, and we do this all the time, is if an individual is older, like in the example of that medical school dean that I talked about, where he was ineligible, or if the individual that wants to be the owner of the program is not of a sufficient health level to qualify for it, then you can look at creating an infinite bank on another family member. Has to be somebody with an insurable interest. And that's what we did for, I'm not going to say his name, but Dr. So-and-so. So yes, so that's what I would look at. I would look at places, do the full financial analysis. How much do you spending in credit card debt? How much are you overspending? Are you saving in money every month? Okay, how much do you save every month? And then do a deeper dive on that savings. I've had people say, yeah, I save $400 a month in my savings account. Great. How long have you been saving? 4 years. Okay, great. So then you do the fast math, 4 years at $400 a month, that should be a ton of money. Okay, you're $20,000. And then you say, well, how much money is in the savings account right now? Oh, nothing. Where's the money? Well, I spent it. So in that example, the savings, $400 a month, isn't a real savings. So you can't use that as replacement money because they're not saving it, they're spending it. So you have to dive deep into some of those questions. All right. Look, folks, anybody else before we get rolling? Because I hear dinner.
I just wanted to mention what a great salesman Scott is.
Salesman.
Yeah.
I'm not a salesman.
One policy on me, one policy for my business, and an annuity rollover.
Andy, Drew, I am not a salesman. I am a consultant. Okay. I simply showed you things that you weren't aware of. That's all I did. You made the decision.
Indeed.
All right. All right, folks, it's been a pleasure. And Andy, thank you again. And I'm making a note now. I'll get Madonna to get that check out to you in the mail tomorrow for all your positive comments. Appreciate you. All right,
Thank you,
everybody.
sir.
Thanks,
Thank
Dr.
you.
Burr.
You cleared up some of the mud.
All right, Aura. Good deal. I'm glad you showed up. All right, everybody. Have a good night.
Like I said, cleared up some of the mud.